Hey everyone, it's Evan here from the Trade Risk on Friday, February 2nd, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. So we had a super exciting week. We had the highest volume that we've seen out of the S&P 500 on the week, eclipsed all of 2017's trading. We have to go back to 2016 since we've seen the amount of volume traded this week. We were down 3.85%. That explains it. One of the biggest drops we've seen in quite a long time. We had bond yields rising to new multi-year highs. We had the VIX spiking 50%, and we have the number of stocks hitting new 52-week lows on the rise right now. So we have a lot to talk about. Stick around. We're going to talk about all of that and some more right now. Okay, let's jump in here with the S&P 500, the SPY ETF. You can see we were down 6 points just on Friday here alone, closing the week right at the lows with a big expansion bar to the downside. We'll talk about that in just a moment. Let's first take a look at the weekly chart. We always like to start with the bigger picture to gain some perspective and context. And when we look at the weekly chart here of the SPY ETF, you can see we finished down 11 points. That's 3.88%. So right off the bat, we know it was a large range expansion week lower. We look at volume here, like we mentioned at sort of the top of the episode here, the recording. This was the highest weekly volume that we've seen going all the way back to December of 2016. So this eclipsed all of the trading volume that was done throughout 2017. We saw 600 million shares trade in the SPY this week, so a good amount there of shares transacting. And notably here, we took out last week's lows. We took out the last 2 weeks' lows. However, when we look at this chart from a structural basis, we look at this, we are still holding up in this uptrend. There's been no major technical damage to speak of. We had this micro break below last week's lows. That's not a bullish characteristic, but we are still above all the rising moving averages. We are still holding above all weekly trend lines and fast moving averages. So right now, as bad as the damage looks on an intraday chart or even a daily chart at this point, the weekly picture, the big perspective looking over many months, is still very much intact. So again, know your time frame, know the bigger picture context. Doesn't mean it can't get worse. Just as it stands right now, this is what we're looking at, still holding up, and have retraced approximately 50% of this year's gains. So that is the weekly picture. Now let's take a look at the daily chart here, and let's recap this week a little bit because there were some clues as to how we got here. If you watched Tuesday's video, I think we did a pretty good job at sort of outlining the bearish scenario here. We talked about the bull and the bear case and some things to look for and some levels to watch. So Tuesday's video hopefully got you at least a little bit prepared or in the mindset that we could see some continued action lower. But let's quickly recap what we saw here. So if you recall, we ended last Friday now, so a week ago, we had a strong close to the week. We had this nice exuberant pop higher. We closed at highs. We expanded to new highs here in the S&P 500. And then very quickly, Monday, we already started to notice some slight changes of character in the market. It was an inside day. We closed on the lows, 66 basis points. Not much to speak of there from a technical perspective. But what we noted on Monday was the weakness, the heaviness under the hood, under the market, under the surface of the market, looking at the market internals. We were really heavy on Monday, and the next sort of clue was actually getting some follow through to Monday's weakness. We saw our first follow through day to the downside in what seemed like forever. And once again, market internals told the story of being really heavy. We saw new lows get that uptick. And we talked about that in Tuesday's video, saying we saw for the first time a surge higher. I think it was over a year, a record that we broke to the number of stocks making new 52-week lows, broke out to new yearly highs here on Tuesday, or actually I think it was on Monday. Actually, I don't have the the chart in front of me. I think it was Monday or Tuesday. We talked about it in Tuesday's video, and I think that was sort of a good second clue as to something, something changing here with a follow-through day and market internals being as heavy as they were. I think the third clue here now was on Wednesday and Thursday. We spent those days chopping around, and that's fairly innocent in itself. I don't think it's a win really for one side or the other. But the one thing, at least we were talking or writing to subscribers on throughout this time, is that we hadn't had the ability to quickly fill this gap. And I think that was another sort of interesting micro data point there of looking at the market sort of consolidate. We made two attempts. We made an attempt right here on Wednesday. We made another attempt sort of late in the afternoon on Thursday to try and get a rally, try and get into this gap, but it never happened. And we basically had trapped supply down here, this gap down held in its place, which led to Friday's sort of expansion to the downside here on a real heavy strong selling session here, 2%, 170 million shares coming in, so a good amount of volume traded, creating a little bit of panic, which is something we haven't seen in forever either, getting us all the way and closing us right at the lows. So on Tuesday's video, I think we talked about the 278 level, 279 level as a potential sort of 20-day moving average test. That would be the next level I'd be paying attention to. And clearly, given today's action, we cut right through that like nothing was even there, and the market fell another 3 or so points to this 275, 275.50. So when we start to think about some levels now, we take a look perhaps at some fibs. We're about 50 or so percent, I think, retraced from the January start of this year. So if we go in here, actually a little bit further along, coming close into the 61.8% retracement, we had this little bit of a dip here on the 10th. On Wednesday. So we had this little slight pullback day where we found some support reversed. So maybe a little bit of structure there we could pay attention to, but it's pretty, there's a good amount of room to kind of float in here and potentially continue in this acceleration pattern. The other kind of level I would pay attention to, we talked about, in the past several videos, we talked about this trend line right here. And, that was something that, again, was another factor that we saw broke on Tuesday. We talked about that. So that trend line broke. But if we zoom out a little bit, we actually have this other trend line. I know my chart's a little bit messy here, but bear with me, and I'm not going to draw this exact. You can refine this on your own system. But if you extend it from the August 27, so this consolidation we saw in summertime of 2017, that's what started off sort of this latest ramp higher here. And if you were to extend that trend line out, you find somewhere right in this 271 area, getting really close to almost flat on the year. Not saying we have to get there by any means, just saying that this could be another spot to potentially retest. Again, this might coincide more with a weekly trend line. As you can see here, that's from this structure here. So this is a little bit more of a significant sort of trend line, more intermediate term, and that might be something to pay attention to, or if people are managing risk against, to pay attention to. And again, it comes around this round 270 number and flat on the year. So that's something to think about when we start to look into next week. A few other things to mention, heading into the end of the week, particularly Friday here, the number of stocks hitting new 52-week lows continuing to rise. Again, we mentioned that on Tuesday, and it was kind of a single data point, single point day. But now that we've gotten a few consecutive days of an uptick in the stocks hitting new lows, that to me starts to get a little bit concerning. I'm not saying that it has to be some epic meltdown here, or that there's a big bear market right across, starting off next week. Just being aware that, again, some signs of transition here. Maybe we have some more softening to come. Maybe it's not just a quick 3% pullback. That would be, sort of the bearish sort of scenario there. If those market internals, if the number of stocks hitting new 52-week lows continues to accelerate and hold at a strong level. Now, on the flip side, I'll give you some constructive action here. If we look at something like the number of stocks above a 5-day simple moving average, that is already almost at a 2 standard deviation move to the downside. In other words, we did cover quite a bit of ground here to the downside in a short period of time. So maybe a bounce and stabilization is going to be the first sort of course of action coming into next week. There is some short-term sort of oversold levels. And again, if you keep the longer-term trend of higher prices in context here, maybe this is a point at which you want to start thinking about looking at stocks that are holding up. Again, it's not specific advice because everybody's working with different time frames and strategies, but something to think about that we do have some of those near-term, very near-term signals that are already in oversold conditions. We also see something like the VIX, which has spiked 50%. That traditionally has been pretty aggressively, a mean reversion instrument. You can see we're breaking to new highs here in the VIX. Again, this doesn't come without risks. I'm not saying to short the VIX or jump into XIV or anything like that, but just understand that we did just, price in a good amount of fear this week. We did have a nice 3.5%, almost actually 4% down week. So that level of a pullback in such a short order is not something we've seen in quite a bit of time. And like we talked about on Tuesday, again, high momentum, new momentum, fresh high markets that we've been trading in. When you start to get those first pullbacks, you want to pay attention to them. And generally speaking, they are more opportunities than they are risks. So again, a lot of that comes down to time frame, so I'm not going to speak too much more on that. I mean, as far as my strategy as an active swing trader, we had the luxury today of coming in still holding a short position in the S&P 500. We put that on here on Monday. We covered 60% of it on Tuesday. We covered the rest today. Certainly not at the lows. It would have been nice, more so right around, I think 278 earlier in the session is when we closed out the rest of our short position here, and we did a little bit of buying at the close of the day, but I am not but I'm fully aware that more downside here in the short term heading into next week is totally possible. So make sure you're position sizing accordingly and you're managing that risk as always. That's just my game plan from a short to intermediate term swing trader's approach. So I think that is just about everything I think I wanted to talk about here on the S&P 500. I think short term, we've seen a good flush, we've seen some panic. Maybe we get a little bit of rebound, but you also have those longer term trend lines in play. And I think you also need to be cautious on the intermediate term if you still see the number of stocks hitting new 52-week lows continue to rise. So that's the S&P 500. Let's look at the IWM down 1.93%, which, when I look at the S&P 500, the S&P 500 was actually down over 2% by the close. The fact that the Russell was only down less than the S&P 500 is actually a little bit surprising to me. I mean, there is still some technical damage here for sure. We broke through multiple levels of horizontal support. We broke the 20-period moving average. We broke this trend line here. So there is some damage here on the Russell 2000 on the daily chart. And if you look at the weekly, a little bit more pessimistic than the S&P 500, but still holding above a 20-period moving average, which is rising. So the Russell here, I think, is, again, is just in the penalty box here. But I would note that, and I'm sort of surprised we didn't see the Russell down 3% or 3.5% given what the S&P 500 did today. So that's the Russell. I think for the next levels here, 151 or so, that's going to be a pretty big level. That's where a lot of resistance or a lot of supply was kind of carved out. We originally had that as resistance through October of 2017. We found support there in December, early January. Then we started to lift higher above it. So there's quite a bit of supply coming in just a few points below IWM. I'd be paying attention to that if we got follow through. And then if we look at the NASDAQ 100, you can see here, again, breaking below the 20 period, 1.99%. So it actually outperformed just a bit here on a relative basis to the S&P 500. No, that's being pretty specific, but you can see again high volume sell-off. If we go to the weekly chart, again still above an 8-period EMA that is rising. We took out last week's lows, not the last 2 weeks lows, 3.7% to the downside. So certainly a pullback in motion here. We're off of the highs, high volume. Basically very similar comments to the S&P 500. Look at this level right around 161, and then you have the big level down here, which was the breakout or retest of year-to-date levels. So that's the market environment overall. I think that's pretty clear at this point of what we got going on. Let's look at some other markets. We saw TLT really get hammered this week. It was basically in line with equity markets, down 3.24%, which is a huge move for TLT. And if we look at the volume that came in this week, 84 million shares here in the TLT. You got to go all the way back to 2011, it looks like, to see that type of volume coming in, maybe a bit in 2014. So quite a big move and losing a very significant level here on the weekly chart. Take a look at breaking the support. It tested, it held many times. We talked about this on Tuesday. We made mention on Tuesday that it was starting to break. We said, let's see if we get that weekly close for confirmation. And sure, we absolutely did get that weekly close for confirmation. So TLT looks to be in rough shape here. And really, it's all, you know, if we look at the 7-year bond as well, so the shorter term rates really accelerating lower here, or the bonds getting crushed, rates on the rise this week, significantly so. And you can see the volume coming in here as it breaks to new multi-year lows on the shorter term curve as well. So that's certainly putting some pressure there on equity markets, or got some certainly funds flowing around in between those assets. If we look at GLD, we'll go to metals next, you could see 1.31% down here on the week and on the day here as well on Friday. You can see, all things considered, still holding up fairly reasonable, testing its 20 period, closing right at the 20 period. Good volume coming in here on Friday. So a pause, a digestion, a bigger consolidation is certainly would not be the worst thing in the world, given it's had such a strong V-shaped kind of move from these lows here starting in December and at the beginning of this year. So a little bit of a kind of consolidation here, not not the most bearish thing in the world. Let's see if we give it some time to settle in here, carve out some upper level sort of base, and that could be a good, interesting trade for us, shaping up into mid to late December. February. Silver is a trade that we got burned on this week. We did try and get long it right here on Wednesdays. It started to break back above this 1630 level, took it with a little bit smaller size, understanding that it did look fairly choppy and not fully convincing at this price or at this time. It had a down day on Thursday and then completely fell apart right alongside equities here on Friday. So we stopped ourselves out here intraday on silver on Friday, no longer in that trade. Looks like it's, certainly making new multi-week lows here, or actually new lows on the year. It looks like it did go red negative with today's move. So let's see if we can get some stabilization here above ideally 1550, get back inside this base. Maybe it sets up for us later this month or into March, but certainly needs more time and rejected those higher prices. If we go to oil next, you can see oil held up, all things considered. So commodities not doing terribly bad here for the week, 1.51% for USO. It's an inside week, but still holding up very strong in this trend, all things considered. Natural gas, not as fortunate, not as bullish here, 10% move down, and you can see taking out the lows from last week. If we go down to that daily chart, once again, you can see we lost the 20 period. This V-shaped right into a lot of overhead supply in here that we were talking about in this $27 area. So it did react off of it, pulled back. Let's see if the bulls can put in yet another higher low here, stabilize us, and maybe this sets up for future for us, but right now not seeing a whole lot. So that is the market overall. Let's take a look at some sectors. We'll start with some things that are holding up reasonably well. XLI, I mean, it's clearly suffered some damage here in the short term, breaking through the lows here from the past couple of weeks. But if we look at this trend, if we zoom out here, we notice that, if we look at, I guess, even the weekly chart, you can see it's still above a rising 8-period EMA, which is above a rising 20-period EMA. You can see we are still, about 50% of the way up, or even maybe even a little bit more shallow in the XLI from the start of the year. So a pullback here is not the most bearish thing in the world for XLI. So let's, look at that as a potential, relative strength area. Financials, similar thing here, actually still holding on to the 20 period, not feeling the full brunt of the selling over this past week. It certainly got hit on Friday, but once again, still holding up reasonably well here for financials. Healthcare kind of in this camp as well, a little bit more wild. It had this parabolic move towards the end of last week, so it did retrace a bit more of that, but you can see from this bigger picture context, again, a little bit of a pullback here, not the worst thing in the world, and thanks to mostly Amazon here, XLY discretionary ETF, you can see pulling back, still holding above the 20 period EMA, but still some good volume coming in, but on a relative basis holding up compared to things like energy, which is really suffering more of a steeper pullback, higher volume, 4% down here just on Friday alone, 30 million shares. This and really, you know, getting to the point where it's retraced almost this entire year's worth of gains. In fact, did it do that? Let's take a look at the yearly chart. Very close. So it's up 28 basis points, just 20 cents here for the year in XLE. So you can see compared to this sector, energy stocks, really, you know, this is where some of the bigger selling was occurring this week. Materials also getting slammed. You can see here big 2.63% move lower after 1.37% lower on Thursday. And just like energy, this is actually, looks like this has gone negative on the year for materials, down 7 cents on the year. So much larger underperformance here in energy, materials, and IYT, I think would be the last I would throw in that bucket. This started the weakness first. So this was the first kind of group here. This even was starting to break down last week. This was already off of the highs, pulling off, and then it just kind of continued with those losses this week, and this has gone red on the year as well. Let's pull up, oh no, almost, God, I can't get these things right, 70 cents. It is still up, so almost red on the year, still up fractionally for IYT, so some good underperformance there as well. So I think that's all I had for this week. Hopefully you were able to navigate this okay. Hopefully the sudden surge in volatility didn't catch you off guard too much, and even if it did, at least, you know, you kind of get that wake-up call. We've been in a sleepy market for quite a long time. The first move lower will always kind of startle most people, you know, the largest, but now if we start to get back to managing risk and adjusting accordingly, dropping those sizes, you know, doing what you need to do to stay in the game, live to fight another day. Risk management's always number one. Thanks so much for watching these videos. If you like them, do subscribe to our YouTube channel. Have a great rest of your weekend, and I will talk to you on Tuesday.